Hello learner, welcome to Equity Investment Analysis. We will be looking at the free cash flow valuation and we are looking at lesson 3, free cash flow to equity two-stage model. So what we had looked at before, we had looked at in lesson 2, we had looked at the free FCFF two-stage model, where we had built on the FCFF. Then we said it's starting from net income plus non-cash charges plus interest minus tax minus fixed capital investments minus working capital investments, like that. And we were able to grow the components of net income, non-cash charges, interest, minus tax, as well as fixed capital investments based on that example that we had done in lesson 2. What we said was that the growth rate in FCFF will not remain stable, but will probably decline over the life of the value of the farm. So this is stage 1, this is stage 2, like that. And in that example, the growth rates were maintained here. We had a different weighted average cost of capital of this stage and a different weighted average cost of capital in that stage. Now, we need to proceed and look at the two-stage, or FCFF two-stage model. Rather, FCFE model. In this stage, it is similar to that. So we are saying we had something like this, which we had drawn in lesson 2. And we say this is stage 1, stage 2. So the growth rate in, this is FCFF growth. This is FCFE growth. There. So what now we need to build on is the model on the two-stage FCFE. Here we said that we are going to arrange these components and try and increase them. We have just repeated what I've just said. But now in the FCFE, what we'll look at, so the FCFE, the inputs towards calculating the FCFE in the two-stage include, we start with net income, minus 1 minus debt ratio, like that, multiplied by fixed capital investments net of depreciation. That. Then we minus 1 minus debt ratio, again, multiplied by working capital investments. That is the model for the two-stage FCFE. To try and demonstrate this two-stage FCFE, let's look at an example. Consider a company which has revenues of 20 million this year. We assume that its future performance will be tracked relative to sales as follows. Number 1, sales growth and net profit margin are projected by year as shown in the table below. Note 2, fixed capital investments net of depreciation is projected to be 30% of the sales increase in each year. Working capital investments or requirements are 7% of projected shilling increase in sales each year. Debt will finance 40% of investments in net capital and working capital. The company has 12% required rate of return on equity. The firm has 1 million shares of common stock outstanding. Calculate the value of equity of S company using two-stage FCFE. Now, this question, we need to first of all draw a table similar to the one which you had done in lesson 2. So we say that we have first of all the sales growth given to us there. And then we need to also have, of course, the year will have to be given to us here. 1, 2, 3, 4, 5, and 6, like that. Then we will look ahead and try and see what have we been given in the information. We've also been given the net profit margin. The net profit margin. There, that. Then we're saying the sales growth, we write them because these ones have already been given 30%. We have 25%, 20 and 15%, 15% very quickly. And then we have 10 and 5, 10% and 5%. Yeah. The net profit margin as well, we just include them very quickly. So 8%, then 7.5 and 7%, 7%. We also have 6%, and we have 5.5%, as well as 5%, finally. 5% there. Now, from the information, we only have the revenues currently, or in year 0. If we had another column here, year 0, we have the sales. So we can now include the sales right there. So the sales in year 0 is 20 million. However, we have been given the growth rate in sales as being 30%. So what happens? Can we be able to move on this side? Sales computation. Now we have year 0, 1, 2, 3, 4, 5, and 6. So for us to get the sales computation, we need to get, first of all, the sales in year 0. The sales in year 0 was 20 million. And we're saying the sales in year 1 will now be grown by 30%. So we're saying it is 20 multiplied by 1.3. How much do we get? The sales in year 2, we need the answer, first of all, from year 1. So we first of all compute the ones which is in year 1. We're saying 20 times 1.3. We have 26. So 26 multiplied by now. The growth rate is 25%, so 1.25. 26 times 1.25 is 32.5. Then we have 32.5 multiplied by now 1.2. 1.2, 39. Then you're saying 39 multiplied by now how much? Is it 15%? So 1.15. 0.15. We have 44.85. Then we have 44.85 multiplied by what percentage? 10%. 1.1. By 1.1. 49.33. 33, like that. Then we have now for year 6, 49.33 multiplied by 1.05. 1.05, 51.8. There. Now we come and slot in the values over here. So we have now 26, 32.5, 39, 44.85, 49.33, and 51.8. Now we get the inputs as per this FCFE model. So we arrange it now in a columnar format. We start now by net income. Then we will now put in the component. So you see it's net income minus 1 minus debt ratio moving like that. So this mass product must be multiplied by the fixed capital investments net of depreciation. So I can write now in a columnar format 1 minus DR, that is the debt ratio. We can also include the fixed capital in investments minus depreciation like that. Now this component will have to be computed. That and the values put there, the product between these. So we are saying multiplied by 1 minus DR multiplied by fixed capital investments net of depreciation, because that represents that part. Then we will continue and say minus 1 minus DR times working capital investment. So we have now another one, 1 minus DR, like that, and then working capital investments, like that. So this component as well, we will be able to get the product of that. So if you'll allow me, I can keep a space here a small space here so that we can be able to compute now the product values. This times that, we get the product value there. This times that, we get the product value like that there. And then we will be able to get the FCFEs like that. Now the FCFE, if you'll allow me, I can double underline that one because that is exactly what we are looking for there. So let's work it out. Net income. So net income computation. There. What have we been given? We have been given the net profit margin. Net profit margin is given as net income or net profit margin is given as net income divided by sales value. So we can be able to multiply the sales times the net profit margin will give us the net income, and then we'll be able to come and slot it over there. So net profit margin multiplied by sales will give us net income. That. So can we do? We have the net profit margin given to us there as 8%. So for year 1, so we do 1, 2, 3, 4, and then I'll move over on the other side to calculate 5 and 6. So let's first of all rub so that once we start, we will just slot in the values. 5 and 6 there. So the net profit margin is how much? Is we've been given 8%, so 0.08 multiplied by the sales value. The sales value is 26. How much is the net profit margin? So let's write the values first, then we can get the net incomes. So in net profit margin, 0.075 multiplied by 32.5. Then 0.07 multiplied by 39. Then 44.85, so is multiplied by 6%. 44.85. Yeah. Then 49.33 is being multiplied by 5.5%. 0.055 times 49.33. Then 5% being multiplied by 51.8. So how much do we get? Come back over on this side. We have 0.08 multiplied by 26, 2.08. 0.075 multiplied by 32.5, 2.44. Then 0.07 multiplied by 39, 2.73. Then 0.06 multiplied by 44.85, 2.69. There. For year 5, 0.055 multiplied by 49.33, 2.71. Then we have 0.05 multiplied by 51.8, 2.59. Now we slot in the values on our table here, summary table. So we have 2.08, then we have 2.44, 2.73, 2.69, 2.71, 2.59. There. The debt ratio we have been given in the question. Debt will finance 40% of the investments in net working capital, in net capital and working capital. Meaning what? Meaning that 1 minus 40% is 60%. So you can be able to confidently come and put 0.6 here, 0.6, because that one is constant. 0.6, 0.6, 6, 0.6, 0.6, and like that. Now, we need to get this component of fixed capital investments net of depreciation. If you look at note number 2, or bullet number 2 rather, fixed capital investment net of depreciation is projected to be 30% of the sales increase in each year. So we already have computed the sales. So we say from 20 to 26, we can say the increase in sales. There we can put it just beside the sales computation there. So we have, in the first case, it is 6, and then 32.5 minus 26, 6.5, and then 39 minus 32.5, 6.5. Then we have 44.85 minus 39 gives 5.85. Then we have 49.33 minus 44.85. We have 4.48. Then finally 51.8 minus 49.33. We have 2.47 there. Now, to get the fixed capital investments, we have been told that it is 30% of the increase there. So the increase has been computed right over here. We just multiply with 30% and we correspondingly put it over here in on that column there. So we say in the first case it is 6 multiplied by 30%. That is 1.8. Then we have 6.5 multiplied by 30%, 1.95. Then we have again 1.95 because it's 6.5 there. Then 5.85 multiplied by 30%, we have 1.76. Then in year 5 we have 4.48 multiplied by 30%, 1.34. Then we have 2.47 multiplied by 30%. We have 0.74. 0.74. We get the product because I have put that braces like that. So you multiply this times this. Going by the formula, we have this multiplied by that. And the answer should be negative because you're going to less it from the net income. So this minus the product of that there. So how much are we getting? 0.6 multiplied by 1.8. We have 1.08 there. Put that in brackets there. So 0.6 multiplied by 1.95. We have 1.17. 1.17 because it's the same value there. Then we have 1.76 multiplied by 0.6. We have 1.06, can say that. And 1.34 multiplied by 0.6, 0.80. Finally, 0.74 multiplied by 0.6. We have 0.44 there. The 1 minus debt ratio is same as this component here, or that part there. So we put 0.6, 0.6, 0.6, 0.6, 0.66, like that. What about the working capital investments? What have we been told in the working capital investments? In the working capital investments, we have been told that, that is note number 3, working capital requirements are 7% of projected shilling increase in sales each year. So 7%. So 0.07 multiplied by 6. In the first case, we already calculated the increase in sales there. So we just get 7% of that times 6. We have 0.42 there. Then 0.42 0.07 multiplied by 6.5, we have 0.45, 0.46 as well there. Then we have 0.07 multiplied by 5.85, 0.41. Then 2.47 multiplied by 0.07. We have 0. Have I really computed it the same, or I might have mixed up one of them, because you're saying years number 2 and 3 have got the same value, and then we need 5.85. Yes, so 5.85. Let me confirm. 07 times 5.85, we get 0.41. 0.41, yes, and then 4.48 should be now the next one. So 4.48, 4.48 multiplied by 0.07, 0.31. 0.07 times 2.47, 0.17. We get the product of that, because we are saying that these are in braces, in braces there. So this times that, that's what we are doing by doing that computation. 0.6 multiplied by 0.42, 0.25 there. Then we have 0.6 multiplied by 0.46, 0.276, 2.28, that's it, 0.28, 0.28, 0.28 as well there. Then 0.6 multiplied by 0.41, 0.25, 0.6 multiplied by 0.31, 0.19. 0.6 multiplied by 0.17, 0.102. That. This should be in brackets like that. Going by the formula, we will just get the net income, we less this, and then we go ahead and less that, so that we can be able to get the fixed free cash flow to equity there, the respective free cash flow to equities. So in the first case, we get 2.08 minus 1.08, then you minus 0.25, 0.75. Yeah. Then we have now 2.44. We less 1.17. Then we less 0.28, 0.99. 0.99. Or is it going to be the same? Don't think it's going to be the same. I was assuming that is the same. So let me rub off that. Let's see the correct value. 2.73 minus 1.17 minus 0.28. 1.28. We have 1.28 there. So we have for year 4, 2.69 minus 1.06, then you less 0.25, 1.38 there. So we have year 5 now, 2.71, we are at that point there, 2.71, 2.71, you less 0.8, then you less 0.19, 1.72. Finally, we have 2.59, we less 0.44, then we less 0.102, 2.048, 4. 2.05. Let's say 2.05. Done. Just as the way we had done in our lesson 2, when we're looking at the free cash flow to farm, two-stage. Now the two-stage FCFE. What do? We first of all get the terminal value there. So we get terminal value is given as FCFE, 6, over R minus G, not work minus G in this case, it's R minus G. So we get the FCFE, which is in period 6, is 2.05 divided by the required rate of return. How much have you been given the required rate of return? You look at bullet number 5 there, 12%. Minus the growth rate. Now the growth rate in this case, we've actually been given the growth rate over here being 5%, so we less 0.05. Notice where this growth rate is, that is the 5%. You're not going to use the one for 10% there. So how much do we get as the terminal value? 2.05 we divide by 0.12 minus 0.5. We get 29.28. There. So once we have the 29.28 like there, what we are supposed to do now is to discount these values from year 1, 2, 3, 4, and 5 based on the appropriate required rate of return. So we come over, I don't want to wrap this part, so if you allow me, I can come on this other side here. Come on this side. So we are saying value of equity, VE, is given as the first free cash flow to equity is 0.75 discounted against 1 plus R. R is 0.12 plus 0.99, 1.12 squared plus 1.28, 1.12 cubed plus 1.38, 1.12 power 4 plus 1.72, 1.12 power 5 plus the component of perpetuity. This terminal value needs to be discounted against the required return. So we get 29.28 divided by 1.12 power 5 there. So how much do we get there? So like I said, I usually prefer to calculate them independently, then I just add. So we have 0.75 divided by 1.12, 0.67 plus divided by 1.12 squared, 0.79. 1.28 divided by 1.12 power 3 or cubed, 1.28 cubed divided by 1.28 divided by 1.12 divided by 1.12 cubed, we get 0.91. Then we come here, 1.38 divided by 1.12 power 4, 0.88. So we put a plus, then we plus now 1.72 divided by 1.12 power 5, 0.98. There finally, component of perpetuity, we get 29.28 divided by 1.12 power 5, 16.61. So So how much do we get as the value of equity? We get now 16.61 plus, now we add 0.98 plus 0.88 plus 0.91 plus 0.79 plus 0.67. 20.84. That is the value of equity. If we want to get the per share value of equity, then we need to go ahead and divide this by the number of shares outstanding. If we've been provided the number of shares outstanding, the number of shares outstanding is 1 million. So we say that the per share value of equity is 20.84 per share. So the per share value of the per share value of equity, we just get 20.84 divided by 1 million shares. That one represents the million shares. We get 20.84 per share. So that concludes our lesson 3 on the 2-stage FCFE. We hope that we can be able to meet in our lesson 4 for the 3-stage valuation models of free cash flow. Thank you and God bless you.
Thank you for watching this video. Don't forget to get yourself a copy of our professionally prepared study text and revision partners. Visit our shop along Tom Boyer Street, Pioneer House, 3rd floor, opposite Fire Station.